Welcome to my webinar, What is Private Equity Banking? My name is Eric Martineau, and this is my lovely wife, Diane. We are the owners of PrivateEquityBanking.com. Pretty cool name, isn't it? Well, let me define what it is, okay? That's what I want to do tonight. What is private equity banking? Well, it is a concept, not a private bank where you're going to go get private funds like hard money lending, okay? It's a concept. But it comes with powerful tools and IRS guidelines that back it up that allow us to act as our own bank. Let me delve into some of the powers of private equity banking. So what is it? First and foremost, it is private. Every cash accumulation account, and by the way, as I said, it's backed by the IRS, and that is their term, cash accumulation contract. I know I'll goof up and call it cash accumulation account at times, but the IRS calls it a cash accumulation contract. And it is designed specifically for you, around your abilities, your needs, your goals, your desires, etc. So there's no one size fits all. Secondly, it is private equity. In other words, every cash accumulation contract is filled with your own money, your cash, your equity. All right? Third, it is a banking concept, right? So every cash accumulation contract takes on the banking functions that a typical bank account would provide you: checking, savings, borrowing, things of that nature. Okay? So quickly, let's run through, in my mind, to separate out some of the functions of money. The first one is the banking function, and that's what this conversation is about this evening. Also, investing function and the spending function of money. Now, from a banking standpoint, I want to divide out these because for banking function, what I'm talking about here is the warehousing or the borrowing of money. When I put money into a warehouse, an institution that's going to care for my money, I expect it to be safe. I don't want any risk, no taxes, if I could get away with it. Anytime I want to get a hold of my money, I want access to it. So not like a 401k that I can't touch until I'm 59 or whatever. I know I'm getting close. Guaranteed growth, I also want that. Now, investing function. This is where I take my money out of the warehouse and I go put it into an investment. And I expect to increase the value of my money when I put it there. And that is usually, if not always, accompanied by some kind of risk. Say in the stock market, or I buy real estate, or what have you. I'm expecting a larger return on my investment by putting my money to work and putting it at risk. I also add to the investing column here paying off debt. Now, why do I do that? That's because every time I pay off a debt, I have more liquidity that can go back up into my warehouse. And every time I have more money up in my warehouse, I can then take it out either for investing or spending. Now, on the spending side, I think we almost all of us understand this one. There is an opportunity cost involved. When you give away your money to buy something, it's gone. You can't get it back. And so we use the spending function for maintaining our lifestyle, taxes, food, emergencies, and then we also use it to improve our lifestyle, to buy another home, another automobile, an education, things of that nature. Now, I want to be very clear about something. At least as I define it, it's no better than just that, my definition, investing side is not the warehousing side. And the main component there that differentiates it for me is risk. When I've got my money in a warehouse, it is safe and there's no risk. When I've moved it out into the market where there is risk, that's when I call it investing. So for my terminology, I want to distinguish that. Why? Because sometimes in these warehousing accounts, these cash accumulation accounts, because we're given compound interest, after years of compound interest, we'll find that many times our warehouse outstrips that which we are using for investing. But I don't want us to confuse the two, because in my mind, one is guaranteed and one incurs risk. All right, so that's the big difference for me. A warehouse is no risk, investing does have risk. Now, the reason I make such a stink about that is because I want to create an investment threshold, right? Right there, that's why I've got a line dividing it. If I have my money in a warehouse, right, and it's making 4, 5, 6%, whatever it's making me, if I can't move that money into an investing arena and expect to make more, I don't move it. And that's why I create an investment threshold. And that's why I have a line that divides the banking, warehousing, and borrowing from the investing and the spending. Okay. It is an infinite banking concept. In fact, many times you'll hear private equity banking called the infinite banking concept. And that's because your cash accumulation contract builds and it continues to grow generational wealth for you and your family infinitely, if structured properly. I guess I should say that too. As I said, there are IRS components, there are other regulations. This is not a simple thing to put together all the time, and if done properly, it will grow for your family infinitely. Before we go much further, I would like to explain what private equity banking is not. This is not a debt consolidation program. This is not an investment strategy. As I just said, there's no risk involved, so for me, it is not an investment strategy. Third, this is not a do-it-yourself project, all right? As I stated a minute ago, there are IRS regulations that surround the organizations that are able to put together cash accumulation accounts. So this isn't a simple thing to do. It does take a professional with a license to do it. Last week I was giving a presentation. I got a whole lot of questions from people asking me, is this about universal life? And so I'll just dispel that right now. This is not about universal life. But universal life follows the trends of the market. And I'm not talking about something that doesn't give us guarantees. Okay? So what are the benefits of private equity banking? One, guaranteed returns, zero market risk. Again, these are cash accumulation contracts, and those contracts come with guaranteed returns, zero market risk. Liquid cash. When I put my money into this warehouse, I expect to get my money whenever I want it. No age restrictions, no funding caps, etc. Protection. When I deposit my money into an institution, right, I want it to be safe. And in this environment, it's safe not only from market risk, but it's also safe from creditors and lawsuits, at least lawsuits in most states. And again, unpredictable economic situations. Who'd have predicted 9/11? Who'd have predicted 2008? Who'd have predicted COVID? We all knew that things like that could happen, so we can't ignore the fact that there will be unpredictable economic events. We just don't know what they are, and we don't know when they'll come. Tax-free. This is one of the most powerful benefits of a private equity banking contract. Again, done properly with following IRS guidelines, everything that is in your cash accumulation account grows tax-free. And you have access to those funds, as I just said, not when you're 59, anytime you want, you have access to those funds tax-free also. One of the most powerful components is obviously compounded interest. That's what we get with these contracts. We'll talk about that more in just a second. And then probably for me, the most powerful of all of these is arbitrage. Right there, arbitrage. We'll define it, we'll talk about it, but arbitrage is what allows these cash accumulation accounts to be different than everything else on the market. Let's talk about these one at a time. Guaranteed returns, zero market risk. A cash accumulation contract, the key term there is contract. And because it's a contract, it comes with guarantees, right? I mean, think about it. What's the only thing that your financial advisor can guarantee you? A big fat zero, that your money will just go down to zero. That is the only thing you can get guaranteed by your financial advisor. What I'm talking about here are guaranteed compound interest on all of your deposits for life. The second thing is there's no market-based risk. So again, these cash accumulation contracts come with guaranteed interest rates, compound interest rates, and no risk. So a question that I like to ask myself and others is, how much of your financial security comes with guarantees? How much of it would you like to have come with guarantees? Again, I'm not suggesting we never have anything out in a risky environment. I have money sitting in a risky investment environment, right? But at each level in our life, if I was 25 or 35 or 45 or 55, 65, 75, you can see how the amount of risk you'd want in your life is going to change. And therefore, the amount of financial security that comes with guarantees becomes more and more important, usually as we age. All right, the next one, liquid cash. As I just stated, no age restrictions to get your money. This is not an IRS qualified plan. This is not a 401k, a 403, a 529, an IRA, or a federal savings plan, okay? With a cash accumulation contract, you can get a hold of your funds at any time you want for any reason that you want. So you have access to your cash whenever you want, and you have access to your cash for whatever you want. You want to take out some money to go on a trip to Barbados? Take out the money. You want to take out the money to invest in a property? Take it out. No one cares. No one asks a question. In fact, as I said, no age restrictions, no credit checks. Business owners, did you catch that one? And no loan application. Again, business owners, did you catch that? You can go and get a hold of these funds anytime you want. No credit checks, no applications. And there's no loan approval process either. You just send in a form and say, I'd like some money, and it is sent to you within a few days. All right, so the third benefit is protection. Protection, as I said a minute ago, from creditors and lawsuits. These are some unique protections that you cannot find, at least that I can think of, in any other savings account, right? So your money is safe from creditors. It's safe from lawsuits, again, in most states. It is in mine. From financial aid limitations also. So if you've got children that are trying to get into college and want to get a scholarship, but you have too much money, there are ways that you can put your money inside of a cash accumulation account so that you can limit your financial aid exposure. Let's just put it that way for your children. Again, if you've got that need, get a hold of me. We can talk about it. Microeconomic swings. There will be no ups and downs in this account. You'll know what it is. So you're not going to get hurt from a microeconomic swing or a macroeconomic swing. What I'm saying here is that your generational wealth, which is growing tax-free, is protected. And here's the question that I like to ask. How much of your financial security depends on people, companies, economic situations you can neither predict nor control? Let that sink in. How much of your financial security depends on others and things that are outside your control? And that's the question that we're asking here. The next one, tax-free growth. As I said just a minute ago, taxation is the number one killer of generational wealth. And America's number one CPA, he's been deemed that by many newspapers, Ed Slott. He put on a presentation once called Retire Safe and Secure with Ed Slott. Now, he doesn't offer cash accumulation accounts. He's not in that business. And in this presentation, he teaches us how to move our money from forever taxed environments to never taxed environments. And as I was just saying, which are shielded from taxes, stock market risk, longevity risk, and running out of enough money into retirement. The reason that I think we get confused at times is we hear language that compares one bucket of money to another bucket of money, and they aren't the same bucket. What do I mean by that? You'll often hear people compare, say, the taxable bucket, our income and our dividends, or the tax deferred bucket, our 401k, our 403, the IRA, etc., with a never taxed bucket, which is death benefits and insurance loans, right? So we cannot, I guess what I should say is, when we are comparing where we're putting our money, we need to remember that some buckets are taxable, some of them are tax deferred, and some of them are never taxed. And according to Ed Slott, he says we need to move as much of our money from the forever taxed environment into the never taxed environment. And that's exactly what these private equity banking accounts do for us. I'd like to point something out about qualified plans. They are a deferral on our taxes, not a deduction from our taxes, even though we think of it that way. Because many times our CPAs will say, well, I got you a deduction. No, you didn't. You got me a deferral. So what I'm going to do is kind of show a $5,000 IRA contribution, one-time contribution, and the 25% tax bracket. So if somebody threw in $5,000 and it's growing at 10%, and by the way, the reason I chose 10% is because it's simple math for me. If you're not familiar with the rule of 72, what it basically says is take the interest rate, in this case I put 10%, but take the interest rate and divide it into 72, and that'll tell you how long it takes to double your money. So if your money is growing at 1% in a money market fund, it's going to take 72 years for your money to double. If it's sitting in a fund that gets you 2%, 36 years, you get the idea. I put 10%, so if I divide 10% into 72, about every 7 years my money is going to double. So if I put in $5,000 at age 45, it's going to be worth $10,000 at age 52, $20,000 at age 59, and $40,000 when I'm ready to retire. All right? But again, this is not a deduction. It's a deferral. And so what the IRS expects us to do, and they've said this in their guidelines, with that 25% that we get to write off. So 25% of $5,000 in the deduction would be a tax savings of $1,250. And the IRS has told us they want us in a post-tax environment to go and invest that money someplace else for our retirement also. So again, if I've got 1,000, well, let me ask you this. What did you do with your $1,250 that you got from the 5,000 that you put into your IRA, your 401k, etc., right? Did you go invest it in the market? Well, I'm going to say that it's going to get invested just like the other, and also at 10%. And by the way, we all know that 10% is a very hard number for the market to reach, especially on a consistent basis, but I'll just use that, like I said, for simplicity. So my 1,250, that's a tax deferral, I put out in the market also at 10%, and it's going to grow in 7 years to 2,500, in another 7 years, another 5,000, and finally another 10,000 when I'm ready to retire. Let me ask you this. When I pull this money out that is just tax deferred and I'm in the 25% tax bracket, how much do I owe? 10,000 in taxes. Oh, but wait, what about the tax savings money I put out there that grew to become 10,000? What happens to it? I owe capital gains, which currently is 15%. So there's another 1,500. I guess the question that I've got is then, where's the savings? Where's the savings on putting my money into a qualified account with the IRS? I know who it does help, the government and Wall Street, but I'm not so sure it helps you and I. So again, a tax deferred bucket is a leaky bucket. Another thing that I usually suggest to people is I'll show them the history of the U.S. marginal tax rate. Remember, it started in, what was it, 1913 or something like that, on Christmas Eve or New Year's Eve, that they started this tax when there were only like 5 or 6 people left in Washington to sign it. Anyhow, that's another story. And they said, no, it'd never go above 8%. And then all of a sudden we got into World War I, and look what it did. All the way up into the 70s, and then it dropped again during the Depression, and then it went back up during World War II, and then Korea and Vietnam, etc. In fact, Ronald Reagan stated in his memoirs that he would not do 3 movies in 1 year, because if he did a 3rd movie, his income was such that the government was taking over 80%. That's why Ronald Reagan slashed tax rates when he got in as president. Sorry, I'm getting off on a tangent there. But remember, this is a marginal tax rate, right? So the thing is that even if you're bringing in as a couple $450,000 a year, I just want you to understand, you're really only paying a marginal rate of about 23.69%, okay? So we are living at one of the lowest tax rates in American history. That said, a lot of that came from Donald Trump. And whether you like him or you hate him, it doesn't matter. The tax code has been written now. Well, I guess President Biden could change it, but if they don't change it, if Congress doesn't change it, we're going to have pretty good taxes for the next, well, I shouldn't say pretty good. We're going to have tax rates that are some of the lowest we've ever had in American history for until 2025 is when those will come to an end and they'll have to be revoted on. So let me ask you, with 9/11 and the aftershock of that and the wars that came after that and COVID and 2008 and many of these other things where we've had stimulus packages, we've put on, as in America, over $20 trillion in debt since 2008, okay? And someone's going to have to pay for that. And so if you think taxes are going to remain low, I'd say think again. I would not bet on deferring my taxes until I'm ready to retire. I'd pay the taxes now. And so that's usually what I suggest to people. So let me ask you a question here. Which bucket do you like most? Taxed, tax deferred, or never taxed? Exactly. Now the more important question, where is most of your money? If you're like most Americans, most of your savings is sitting up there in a tax deferred bucket. It's not over here in a never taxed bucket. So this is the advice I usually give people. Pay your taxes now, get it over with, and get as much of your money into a never taxed environment as you can right now before taxes go up again. And then finally, use arbitrage to access those funds. We'll talk about that in just a second, but that is, again, tax-free money for life. The 5th component is compound interest. Albert Einstein once said that compound interest is the most powerful force in the universe. Think about that. Coming from the gentleman that came up with E equals MC squared, right? The most powerful force in the universe is compound interest. Those who understand it, earn it. Those who don't, pay it. Either or. That's where we're at in this world. So what is compound interest? All of us know what that is, right? It's the initial principal plus all the accumulated interest added on as it moves forward. And you'll see that that little hockey stick starts going up. So it does take time. A private equity banking account isn't going to show real strong fruits of accumulation until years in. But again, this is a generational wealth building tool. All right. So here's the magic again, using the rule of 72 and compound interest. And what I want to try to do here, and I apologize because I just made a big stink about the difference between an accumulation contract and a market-based investment, right? And so, but what I want to do here is compare, if you'll allow me to, a accumulation account, which has the benefits that we've just talked about, and a market-based investment that doesn't. But here's, again, getting back to kind of that threshold though, the guarantee. On my accumulation account, I am guaranteed 4%. Now, they've never missed a dividend on me either, but the guarantee is 4%. So if I started that policy, if I started that accumulation account when I was 29, at 47 it'd be 2,000, at 65 4, etc. But here's the rub. My cash accumulation account is growing without fees. Now, if I had it in an investment out in the stock market, I would have fees. And I'm going to say that fees would probably run between 1.5 and 2.5%. So let's take it out to 6. What I'm trying to show is the value here. I'm not necessarily, I'm not in any way, shape, or form trying to say this is what you're guaranteed or this is what you're getting. Again, the guaranteed portion is right there, 4%. But there is no management fee and there's no taxes. So probably the value you would get here is, again, about 8%. Back to what I was trying to say a while ago. What I'm trying to do is establish the difference between investing and warehousing. And it's this line that I talked about earlier being my opportunity cost bar or my threshold, right? So, by the way, very clear, this is how I determine what my opportunity cost bar is, not yours. This is how I do it in my head. But what I'm trying to establish here is before I take money out of my warehouse and I move it down into an investment environment, I want to know what I'm getting in a no risk environment first. So again, guaranteed about is 4%. My dividends, 0.1 to 0.5%. Okay? Then the fact that I have no fees like I would if I had my money out in the money market or in a stock with a stockbroker, right? 1 to 2%. Tax free. Depending on your tax rate, that's another benefit of between 1.5 and 2.5%. So what I come up with as my opportunity cost bar is somewhere between 6 and 8%. As I said, that's my threshold. And what that means to Eric is that before I take my money out of the warehouse and I move it into an investment, it darn well better be getting me more than 8%, or I'm not going to move it. Because if I don't move it, it still gives me about an 8% benefit, right? If I do move it into a risky environment, once again, what can I be guaranteed? A big fat 0. That is it because of risk. All right, lastly, and this is where the real magic takes off, arbitrage. I said to my wife once that word, and she looked at me and she said, "Aren't you trying to make this simple so that people can understand it?" And I said, "Yeah, but I don't know any other word that means arbitrage." So she looked it up twice that night, just to make sure I didn't get it wrong. Arbitrage. This is the dictionary definition. The simultaneous savings and borrowing of currency in two different accounts to take advantage of different interest rates for the same asset. Okay. You're going to have a cash value accumulation contract. And that contract allows you to have two accounts. One is for savings, and again, the IRS word is contract, cash value accumulation contract. And I know I just called it an account, but because it is contractual, you are given a percentage that you will have compound interest moving forward for the duration of that account, which can last until after you're dead. All right? Borrowing. Again, in the contract, it will stipulate what it costs you to borrow, right? And you'll get another percentage. What's so powerful about that is these are separate accounts. So one continues to grow the savings, even though you're using it as collateral to borrow the other. Let me explain how that works. What we're trying to do here is see the difference between compound interest earned versus simple interest paid. I know, simple concepts, we know them. I'm not trying to sound condescending in any way, shape, or form. It's just sometimes we don't think about this. What we get in our contract is a compound interest guarantee that we'll earn, and that money is going to do just like I have there depicted, continue to grow and grow and grow. Now, when we borrow money, it is simple interest paid. In other words, both the principal and the interest are shrinking as that thing moves forward. Whereas over here in the compound interest, the principal stays the same, the interest grows, and then the compound interest is what takes it into that hockey stick environment of growing. Let me give you another visual on this. Guaranteed compound growth. So this is my accumulation account, and all it can do is grow, and that is guaranteed in writing. Versus when I want to borrow, it's a guaranteed reduction on the amount that I owe, again through simple interest paid. And so the only thing that my debt can do is get smaller and smaller until it's gone. Now, you ask, how on earth is that possible? Simple. Your cash accumulation contract or cash accumulation account acts as nothing more than the collateral that you want for borrowing. And you borrow from the general fund. And so it's the general fund's money that's going down, and it's your personal private equity bank that continues to grow. Does that make sense? That is the real power, the real magic. So let me show you that with numbers, how this actually works. All right, you've got a cash accumulation account or contract, let's say with $50,000 in it, right? And so you, in your contract, are, let's say, getting 5%. I know I just got through saying my contract is 4%, but there's more than one institution that can do these. Depending on what your goals are, they can be at 5, etc., or they could be lower than that too. So mine is at 4. I'm using 5 as an example. This is not a one-size-fits-all. As I said earlier, this is not do-it-yourself. You need to sit down with someone like me that knows what they're doing, and we'll walk through what your goals, as I said, it's private, right? We'll talk about your goals, your needs, your existing financial structure, and we'll come up with the best organization that can offer you this cash accumulation contract. But bear with me, in my example here, I'm saying that my $50,000 is growing at a 5%, and I'm going to use that as collateral because I want to buy a car. So I'm going to go to the organization that just got me this cash accumulation contract, and I'm going to ask to borrow $50,000 from them. And again, what I've put down here is that that's at 5%, the borrowing, to buy this car, right? And since it's a car, I'm going to amortize it over, let's say, 5 years, which would be a normal payment for a car. What would that look like? Well, my cash accumulation contract begins at 50, or is at 50, and I'm going to borrow it. I've got a contract, as I said, at 5% interest over 5 years. So in year 1, it will grow from 50 to 52. The next year, in year 2, up to 55, then 57, then 60. You get the idea. And after 5 years, my cash accumulation contract will have grown by $13,814, taking it to $63,814. Easy to understand, right? But remember, I borrowed from the general fund of the institution that gave me this contract. And I'm going to borrow $50,000 to buy a car. And I'm going to pay 5% interest over 5 years. And so after the end of the first year, I will have paid down the principal to $43,000. And the year after that, $33,000. The year after that, $24,000. The year after that, $13,000. And then finally in the last year, I've paid off my note to my borrowing from the institution that gave me my cash accumulation account. So if we look at the difference between those two, I've got $13,814 positive. I've got a negative of $6,614, which gives me a net gain of $7,200. Let that sink in. That is the power of a cash accumulation account. You never have to give up your opportunity cost of the cash that you have to go buy a car. You see, typically, how would we buy that car? We would either fund it with cash out of our pocket and lose the cash, lose the opportunity cost of ever having that money back, or we'd go and borrow it from an institution and we would have paid that 5% to a different bank. But here, we can do both at the same time from within our own account, or leveraging our account as collateral, and gain $7,200 instead of paying the $6,614 to another institution and still being at zeros. You with me? This is the magic of private equity banking, never going to zero. It's infinite. And that is the definition of arbitrage. All right, so we've just seen guaranteed returns, zero risk, liquid cash, protection, both from creditors and lawsuits, tax-free growth and tax-free access to our funds, compound interest, and arbitrage. What's happening here is that our generational wealth is being protected from debt service. Sure, we borrow, but we borrow from ourselves, and as we just saw in that example, we're making money on what we're borrowing, right? Retirement insecurity. No 2008, no 9/11, no COVID is going to wipe out your qualified plan just months or days or years before you retire. Economic uncertainty. There is none. You have a contract. You know what it'll be today. You know what it'll be 10 years from now. Taxation. As I've stated, one of the most powerful. Everything in your account grows tax-free, and you have access to that money tax-free for life anytime you want. Again, unlike a 401k or any of these other qualified plans that go up and down with the market, there's none of that risk. All of that is what a private equity banking account is protecting your generational wealth from being destroyed by. All right. So private equity banking has been called the secret of the affluent because you get growth and protection on your money. It's a better system for eliminating debt. Now, I know I said this isn't a debt consolidation, but with that power of arbitrage, you can see quickly how you could have a debt snowball on steroids. If not, call me and I'll give you your real numbers and we can get you out of debt faster than you've ever imagined. A known financial future. To me, that brings the peace of mind I want. Like I said, the guarantees that you get tell you where you will be 5 years, 10 years, 15 years out. There's no questions about it, right? I mean, what would you rather do? Have 100% surety that you'll meet 95% of your financial goals at retirement, or 50% surety that you might make 100% of your goals at retirement? This allows you to structure, as I said earlier, how much of your financial portfolio depends upon situations and people and economic events that you have no control over. Predictability and guarantees, that was what I was just talking about too. This is very predictable. The guarantees give it to you. And the fact that there is no market risk provides you with peace of mind. There's no worry that another pandemic or another housing bubble or another plane crashed into a building is going to cause your portfolio to disappear. You get to build it all tax-free, and you can create generational wealth with a private equity banking account. So what are the ways we can implement a private equity banking account for ourselves? And I'm going to borrow from Robert Kiyosaki, Rich Dad's book called Cash Flow Quadrant to discuss where. There's probably 4 broad categories of where you could implement strategies to help you in your life, starting with employees. The W-2 employee, most of them in debt. And this will allow you and those that you know who are in debt and are W-2 employees to get out of debt faster. Like I said, it's like a snowball method on steroids. Then the self-employed, doctors, lawyers, engineers, real estate agents, lenders, all of those of us that are 1099 because we work for ourselves. That type of or an LLC filing it as an S Corp, right? Something like that. These folks that have a lot of debt, professional debt, doctors, lawyers, etc., great strategies to get them out of debt faster than they would ever have imagined. Business owners. There are fabulous tools that can be used and implemented for business owners to smooth out cash flow, cyclical cash flow. Say you've got a company that makes a lot of money in the summer and hardly any in the winter, or vice versa. We can help flatten out your cash flow needs there also for business. Or you can put, say, your expenses and your taxes. If you're an LLC filing as an S Corp, you know that you have to pay taxes every quarter. Shove this money into your accumulation account, right? Borrow against it when it's time to pay your taxes, and keep everything that you are paying in taxes or expenses or whatever, sitting in an account growing at 4%. And imagine what that'll do over 20 or 35 years that you own your personal business. And then finally, obviously, these accumulation contracts are where the uber wealthy have maintained generational wealth forever because they're able to pass these accounts on to others and keep the ball rolling, if you will, from generation to generation. So, as I stated in the very beginning, these are private and they are created specifically for you. So I can't give you every scenario here. What I'd like to do is invite you to get a hold of me. We'll go through your numbers, we'll talk about what your needs are, and we'll create an account that fits into one of those categories there to help you either eliminate debt for your business, for yourself, or generational wealth for years to come. Thank you for your time. My name, Eric Martineau. Get a hold of me right there, 801-888-5560. My email at martineauagency.com. Love to hear from you. Love to help you out. Thanks for spending some time with me today.